Hey everyone, and welcome to This Explainer. Today, we are diving into a concept that honestly dictates pretty much every aspect of our lives, yet remains wildly misunderstood by almost everyone. We're talking about money. I mean, whether you're a beggar on the street or a billionaire chilling in a penthouse, money is that one thing that universally commands our attention. It is literally the invisible force that pushed humanity out of the forests and built our cloud-touching skyscrapers. But what exactly is it? How in the world did it become the absolute bedrock of human civilization?
So where did money actually get all this power? It's a fantastic question to kick things off. I mean, think about it for a second. A banknote has absolutely zero intrinsic value. It is literally just a piece of paper. You can't eat it, you can't build a house out of it, and it definitely won't keep you warm at night. Yet somehow, it dictates the value of everything else in the world, from the food on our tables to the cars we drive. To really understand how a simple piece of paper runs our entire world, we have to look at what the source material reveals about human psychology.
And the source makes a really fascinating and honestly pretty blunt claim here. It says money has evolved way beyond just being a basic utility. It's actually an addiction in itself. Think about it. It's the single universal language. It's understood by everyone, from a PhD scholar to someone who has never even set foot in a school. It crosses borders, cultures, and generations without missing a single beat. But to really wrap our heads around how we got collectively hooked on this massive global system, we need to look back at exactly how this addiction formed in the first place.
If we look back, the evolution of money happens in these massive, distinct leaps. 5,000 years ago, we were relying entirely on the barter system. Fast forward to about 3,000 years ago, and we shifted to commodities, things like cattle, grain, even tobacco. Then 2,000 years ago, boom, we introduced universal gold and silver coins. And finally, just about 500 years ago, we saw the birth of the paper IOU receipt. This journey, from trading literal cows to exchanging tiny slips of paper, is just totally fascinating.
But listen, humans don't just go around changing global economic systems for the fun of it, right? Every single one of these eras faced massive friction. With the barter system, you had to find an exact match. Like, if you had rice and wanted sugar, you had to miraculously find a guy who not only had sugar, but specifically wanted your rice. It was a nightmare. Then, when we moved to commodities, well, the goods perished. Animals died and grain rotted. Even when we finally switched to gold and silver coins to fix that perishing problem, we just created a whole new set of headaches. Gold was incredibly heavy to lug around, and there was this constant looming fear of getting robbed. We desperately needed a better solution. Okay, so let's dive into that solution, because this right here is the true inciting incident of modern finance. To solve the problem of heavy, easily stolen gold, goldsmiths stepped up and offered a service. They basically told people, hey, keep your gold safely locked up in our vaults. In return, the goldsmith would issue a written safekeeping receipt, an IOU, which literally means I owe you. This little piece of paper guaranteed that the depositor could come back anytime, hand over the receipt, and get their physical gold back. It was simple, it was effective, and it was absolutely brilliant.
And this brilliantly illustrates a massive shift in human psychology, because over time, the goldsmiths started noticing something totally bizarre. Almost nobody was coming back to actually collect their physical gold. I mean, it was just too heavy. Instead, people simply started trading the receipts with each other to do business. They became completely convinced by this one simple idea. If there's a receipt, well, it means there must be gold too. The trust seamlessly transferred away from the heavy, tangible metal directly onto the lightweight, easily transportable paper.
But you know how human nature is. As the source points out, the goldsmiths realized that the receipts themselves had basically become money in the eyes of the public. So they got greedy. They began printing and lending out totally fake receipts that had absolutely zero real gold backing them up in the vault. According to our source material, this unbacked printing basically created the world's very first bank, and what they refer to as the biggest legal scam in history, a system of creating value literally out of thin air that is, incredibly, still running today.
So the really crucial question here is, how does this 500-year-old goldsmith model apply to us today? Like, how does your bank actually work right now? Most of us naturally assume that banks just take our deposits, lend that exact same money out to someone else, charge a higher interest rate, and neatly pocket the difference, right? Well, the source reveals there is actually a massive game happening behind the scenes that most people are completely oblivious to.
To really grasp this game, let's imagine a little scenario. Let's say you walk into your local bank tomorrow morning and deposit exactly 1,000 rupees in crisp, physical cash. 2 500 rupee notes. You hand them over to the teller, and they go straight into the drawer. Now, what actually happens to that physical money once it leaves your hands? Let's walk through the exact mechanics here to demystify the magic. First, you deposit your 1,000 rupees.
Now the bank, which operates under what's called a fractional reserve rule, keeps just 10%, so that's 100 rupees in actual cash in the vault. They loan the remaining 900 out to someone else. Now, that borrower uses the 900 rupees to buy something, maybe a new phone or some groceries. The store owner takes that money and deposits it right back into the bank. Then, the bank takes that new deposit, holds 10% again, so 90 rupees, and loans out the remaining 810. And this cycle just repeats over and over, echoing through the entire economy.
The math here creates a mind-blowing illusion. The actual physical cash sitting in the bank's vault is still just your original 1,000 rupees. But when you log into your banking app, it says you have 1,000 rupees, and when the borrower looks at their app, it says they have 900 rupees. So between the two of you, you genuinely believe you have 1,900 rupees of purchasing power. The bank literally just created 900 rupees of virtual currency simply by typing some numbers into a computer.
Which leads us to this pretty stark mathematical conclusion. Through this continuous looping cycle of lending and redepositing, the bank can easily take your single physical cash deposit of 1,000 rupees and spin it into 10,000 rupees of virtual currency out in the open market. It's a staggering multiplication illusion. And the crazy part? It is entirely based on the assumption that not everyone is going to ask for their money back at the exact same time. Which naturally begs a pretty terrifying question, right? What happens if 20 to 30% of people suddenly panic and try to withdraw their money all at once? Well, the harsh truth, according to the source, is that the bank wouldn't be able to give you your money. Why? Because they literally do not have it. The modern banking system operates purely on probabilities, not on fully backed guarantees.
And the global numbers totally back this up with a statistic that's honestly startling. If you were to add up the balances of all the bank accounts in the entire world, less than 10% of that wealth actually exists as physical, real cash. That means over 90% of the wealth floating around the globe, the money driving economies and funding empires, is nothing more than virtual digits glowing on a screen. It is a massive, globally agreed-upon illusion.
Now, you might be sitting there wondering, why on earth didn't they teach us this in school? Well, the source material offers a highly provocative perspective on that. It argues that this illusion of money has been deliberately made complicated. The dense terminology, the complex math, the endless banking regulations, it's all by design. It's meant to ensure that the common, everyday person cannot easily understand how their wealth is actually being managed, and that keeps them trapped inside the system, continuously trading their precious time for digital numbers.
So how do you protect yourself? The source argues you absolutely must understand this vital comparison, the fundamental difference between currency and money. Most of us use those words interchangeably, but they are not the same thing. Currency is just a medium of exchange. It relies entirely on government trust. If a government decides to reject it overnight, your huge bundles of cash instantly turn into worthless paper. Real money, on the other hand, is a valuable asset in itself. Think physical gold. It retains its intrinsic value no matter what governments do, making it virtually pandemic-proof and crisis-proof.
So what's the practical takeaway for us here? The source makes a really strong, compelling case for holding tangible assets. While financial influencers are constantly out there pushing digital gold bonds or warning you about minor tax implications, the source points out a much harsher reality. In a major crisis, you cannot buy a year's worth of food by waving a digital gold certificate at a farmer. A small amount of physical gold, actually held in your home, can ensure your survival when systems fail. The core advice? Don't base your major life and survival decisions entirely on avoiding a tiny 2 to 4% tax.
It all really boils down to this profound concluding thought from our source. This paper is only about trust, and the world is stable on trust only. Think about it. Whether it's the Goldsmiths' original paper IOU from 500 years ago, or the digital numbers glowing on your smartphone today, our entire financial reality is anchored solely by human belief. If that trust evaporates, the value evaporates right along with it.
Which leaves us with this final, essential question to ponder as we wrap up this explainer. I want you to look at the assets you've worked so incredibly hard to accumulate. Consider your bank balance, your savings. Is your wealth real, tangible, and resilient? Or is it just an illusion built entirely on a fragile web of trust? It's definitely a question worth digging into further. Keep learning, keep questioning, and thank you so much for joining me to unpack the untold truth about money.